Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co host here alongside Stephen Thomas, Chief Economist and founder of Reports on Housing. Today, we will discuss the most recent economic news and statistics, like usual. We'll touch on home insurance, home prices, Phoenix inventory, because that's been pretty crazy lately, tariffs, and so much more. But first, Stephen, like usual, what is going on in the large Thomas household?
First, I was told let's put a timestamp on this. We're doing this on Valentine's Day. Happy Valentine's Day, buddy. I'd be your Valentine, but you have one, so whatever. It's all good. So happy Valentine's Day. And you know what's going on in my household is right now, today, our daughter with my wife, they're touring a couple of schools. I don't know if anybody's heard of the school, UCLA and USC. She wants to be she's a track, a cross country athlete. So she's just seeing all the different colleges with, Division I that are around here because she wants to stay local. But she might even go to New Mexico. That's where she's at. Kids are off today, so I've got kids in the background today because it's a 4-day holiday weekend with President's Day. It's not for Valentine's Day, but for President's Day. And all the sickness has finally left our house. We had Zeke, our youngest, had COVID, and my wife got that flu at the same time. It was awful. And now we're, knock on wood, we're in the clear. So now we move on to track season. So that's where we're at right now. So we have 2 in track, and Mason is going to do soccer, and Zeke is going to do basketball, and all the older ones are doing their different things. So that's what's going on over here. How about you, Mr. Brennan Thomas? What's going on in your neck of the woods?
Well, just recently I presented with you for the first time, so that was a pretty exciting adventure. Something that I'm looking forward to learning more about. I mean, obviously, we've done this for this is our 42nd time, 42nd episode, so decent amount of practice here, but it's a whole different thing trying to present with a whole bunch of eyeballs looking right at you. It's a little bit easier with the camera. So, but I mean, that went pretty well. I was actually very happy, and I'm excited to keep learning on that front. Valentine's, of course, super busy. Um, this upcoming week, I'm going to Hawaii. I am so excited. I'll be leaving a day after this is uploaded. So how exciting is that? I'll be in a whole different state. But other than that, I've been watching Arsenal, of course, and that's been a struggle. Lots of injuries, lots of things going wrong, but also going right. So who knows? But outside of that, I mean, we're just keeping an eye on the data. It seems like different counties are on whole different speeds, and it's very interesting to sort of watch how this year will unfold because, I mean, it's 2025. It's different than last year, different than 2023. So it's pretty exciting. But what I'd love to start on with talking about is economics, because it seems like we've had some pretty large things come out recently. So what happened in the latest sets of jobs data and inflation data?
Well, jobs was like a kind of a mixed bag. The number of jobs created was actually was a little bit less than expectations, but unemployment drove down a little bit. We had a higher participation rate, and also wages went up a little bit as well. So that was kind of a mixed bag. Markets didn't really like it. That kind of mixed bag, and it's just that unemployment's getting to that low. It's getting to to a low level again. That where the Fed, we know that the Fed doesn't want to see it labor market get too hot. If it gets overheated, it can apply more pressure to inflation, and that's why they talk about watching the labor market. They don't want the labor market to break, but they also don't want it to be so hot that it pushes up inflation. So they're watching that. It's a careful balance. I'm not too worried about that, but a lot of investors and traders are. So that was very important. We got CPI this week. I'm not a big fan of CPI. And in that, if you go down to the details, the core went up a little bit. And you actually saw an uptick in the residential side of things, and there shouldn't have been one. And it's kind of hard to watch it all the time because everybody overreacts to it. A better gauge is PCE. The shelter component of it isn't as large, so it's not going to skew things as much. And then we got an inflation read on the manufacturing side, and that was actually it was a little less than expectations on underneath of the hood, but the overall number was a little bit high, and that had to do with other numbers. But when you looked underneath of all the details, it actually showed that that the inflation read that the Fed likes, called PCE, might be a little bit lower than anticipated later on this month. So it's kind of like it's been like a mixed bag. Then we got retail sales out today on Valentine's Day. I woke up and it was way lower than expectations, a lot, enough where we saw a giant change in rates today. So in CPI, it came up. Then we had that manufacturing read PPI yesterday, and we went down. And then we had retail sales today, and it really went down. So we actually, as of right now, are just under 7%. So we got to the lowest rate since the day before the Fed made their announcement in December of where they thought rates would go for the rest of for 2025 and 2026. So and then they shot up above 7% because of the disastrous news conference by Jerome Powell, and while he was speaking, we watched rates go higher, and they have not really gone below 7% since they were down at 6.99% for a day in February, but this is down a little bit further than that. And we'll just have to see, because we can come around Monday and all of a sudden a whole bunch of traders could maybe don't look at 10-year bonds, and then all of a sudden we have rates that go up higher on Monday. So we're just playing right at that 7% threshold. We need a couple more reports that start pushing us closer to down into the sixes. That's what we need to have happen. So we're watching carefully like everybody else, but we're in the meantime, we're burning days and months. So now January's done, February's done. We're above 7% or right at that level. We need to get into the sixes soon so that we can prop up a really good spring market. So that's what we're watching very, very carefully. Year over year, interest rates are actually lower today. So that's something else that we're watching, because that will mean that we'll get better demand the lower rates go.
Yeah, I was gonna say that this week sort of felt like a whiplash where it was all of a sudden rates were like in the seven teens like area, and then now we're all the way back down to 7.9. So it's all over the place. But with a
You mean
combination of
6.9?
that and of course the seasonality, what have you noticed in the real estate market in the past couple of weeks?
So you didn't mean 7.9, you meant 6.9. But that you know, as far as where we're at in the marketplace, all markets, there's different speeds, but all markets are slower this year compared to last year, period. That's across everywhere. So everybody needs to understand that if they're thinking this market this spring is going to be like last spring, you throw that notion out. The only way it can get there is if we finally get interest rates down lower, and we'll let you know when that happens. It's not now. We're still playing right at that 7% level. So really, demand looks very, very similar to last year and the year before. It has not moved much. The only time we saw demand really outperform the prior year was when we got rates down at 6% back in September. And there was a carry through that lasted the whole rest of the year, even though we had rates return above 7% in October. So we need it to be below 7% for duration, and it will really set things up, but we're not quite there yet. So in the meantime, we're going to follow last year's demand curve. It'll be very, very similar. Sometimes it'll beat it. Sometimes it'll be a little bit less. So as a result of that, with very, very similar demand, we have more homes on the market. There are a lot more homes across all markets. Every market has more homes in it. And the problem is, I told you that pending sales activity demand is the same. This year, there are more homeowners coming on the market than last year. Last year, there were more homeowners coming on the market than 2023. That was actually a good thing because we need the extra homes on the market, but we're matching it up against high interest rates. So these extra homes that are coming on the market are making their way back to the average numbers prior to COVID. They're not there yet. Some markets are hitting it. LA is close to hitting their where they were prior to COVID, the number of homes they place on the market. And in Las Vegas, they're at where they were prior to it. And Vegas, I mean, and then we have Phoenix, it's really close, but not all markets are behaving that way. Orange County, one of them that we look at, is way below the prior to COVID amount. So it's a little bit hotter of a market because it still doesn't have enough inventory. But you just look at it, they're still, even in that Orange County market, all markets, they're placing more homes on the market and they're matched up against the same demand. Well, when you matched up against that little demand in 2023, that made the market hotter in 2023. Then demand was still the same in 2024, more homes coming on the market. They just accumulated over time. Now we have this accumulation. We have a higher level of inventory. If we have that same demand, if we keep right at 7%, these more homes in the market will continue to accumulate and there will be more and more homes and the market will feel more sluggish as the year progresses. The only thing that fixes this is if rates finally do come down a little bit. We're not holding our breath for that to happen. In our prediction for the year is either between 6.5 and 7, or between 7 and 7.5, and we've been kind of playing that 7 to 7.5 right there. We just need to make our way down. So there'll be a number of things that have to happen for that to happen. And it just doesn't look like it's going to be there yet. And it might arrive later on this year. We're just going to have to wait and see, like everybody else is, because that's the way the market works. Jerome Powell and the Federal Reserve said, let's watch the market. Let's watch all the data. They're not forward thinking. They were prior to COVID and all that stuff. They did their COVID, and then inflation went out of control, and they talked about being that it was just what was it? What's the term? I can't remember. Is it
transitory?
What's that?
Transitory. So you're referring to
transitory. My brain was doing some loopity loop right now. Transitory. And because they did that, they're now thinking, we got to be careful. We can't say transitory going forward. We actually made that mistake. So we can't say that this is where we think things are going to go down the road. So instead, they keep on talking about being very data dependent, watching everything. And it's kind of like whichever way the wind blows, that's the way rates go. And that's the way the market is, because they're not very forward thinking. They're not saying, this is where things are going to go. This is how we feel. We've done all the modeling. This is where things are going. They're not talking about doing modeling or anything like that. They're talking about almost like a wait and see attitude. So they're in a wait and see attitude. We all are. So that's why we're watching every data point. And it's like what you said, this week alone, whipsaw, you're going back and forth, wondering where rate's going to end up. And then today we end up at below 7% for the first time since December 17th. And that's a long time. So we're just hoping that there's follow through from here. And I got my fingers crossed.
So you talked about elevated inventory levels. And I wanted to ask you, just for clarification, that's not a bad thing. There's nothing in the waters sort of like lurking or anything like that from what you can see.
No, because if you look at it, we're still at these really low numbers as far as where homes are now to where they were during. People are trying to say that we're moving towards a great recession. You need like 4 times the amount of inventory that we have, and we're not going to get it. There's nowhere it's going to come from. What I'm talking about is we're watching inventory come down from where these all-time lows. 2022 was like a historic low, and we hadn't seen a low like that in, since they started tracking numbers. And so that goes way back in time. And we have a higher population too right now. So way more people in the United States than there were even way back when they started tracking. And we still have very few homes in the market. We have a scarcity issue. The issue that we're having is it's a little more sluggish because it's being matched up against very, very low demand. So, but we are getting more homes. It's actually a good thing. This is actually the more that we get at this time, when rates do finally come down, there will be choices for the more buyers that will enter the market to then purchase. Because if this actually happened where interest rates came down last year towards, right around spring or summer, we would be talking very, very low inventory levels right now today. And it would be easier to absorb if we kept those rates at a lower level for a long period of time. So now we're just adding more homes in the market so that when rates rates do come down, we will finally have some sort of an inventory for those buyers to gobble up. And my issue is that the lower rates go, even at 6%, I see a problem because I saw the jump in demand that if you stay there for a long time, it'll be really easy to watch those inventory levels come down pretty substantially as long as they remain there with duration. So that's the longer that we wait before that happens, the more of a buildup of inventory we have, the more that we can watch inventory levels stay at a satisfactory level before they come down too far.
So what has gained most of the chatter as far as inventory goes is Phoenix. A lot of people have been talking about Phoenix as a now like struggling market because their inventory is building up so much. So what do you see happening over in that area?
Yeah, I just don't buy it yet. It's when they say that they're getting back towards pre-COVID levels, it's not a horrific thing. It's just like I said before, we're matching it up against very low demand. The issue that we're having right now is everybody was talking about the big gigantic buildup that occurred and how slow and sluggish the market is, during the holidays? We're right now in the winter market, and that's where demand really spikes up higher, and inventory levels in Phoenix area did increase slightly a little bit, but demand really zoomed up. And for the first time, we actually have our market speed statistic that we follow called expected market time dropped below 100 days. Now, prior to COVID, when you get to, it's at 95, and within the next couple of weeks will drop below 90. Even prior to COVID, anything below 90, 3 months would be considered a slight seller's market. It feels more sluggish in today's market because buyers are more hesitant at overpaying. They really take their time because of the high interest rates. But it's not going to be. It's not like a frozen market. We're looking at other markets that are frozen. You can actually see across the United States and even some of the local markets that we do. I'm doing a piece on vacation rentals. Not vacation rentals, on second homes, like in the mountain areas. Those areas are having more problems. They're kind of like what we see along the Sun Belt. They have issues in Texas and they have issues in Florida. And that's where they can really have a slowdown. Now, we continue at the 7% threshold and we add more homes to Phoenix. And now we're dealing with quite a few homes. And then the demand slows down after the springtime. Yes, you can start peeling off values a little bit, but that's not what's going to happen when we're in the spring in Phoenix. It's going to happen later on in the year if rates remain at that 7% threshold of where they're at right now. But all bets are off. They drop below 7%. They stay there with duration. It's going to be a opposite story. They'll start to see their inventory dwindle. They'll peak earlier than they normally do, and then we start off 2026 with a healthier spot. We just have to watch where rates go. Rates remain at 7% plus. Then what we're going to see is that buildup of inventory slow down, and prices can come down a bit. Slightly. This is not, you can't compare it to the Great Recession or anything like that. There's not the impetus for a lot of people to place their homes on the market and really slash the prices. That's what happened during the Great Recession because people didn't really own that much equity in their homes. So as a result, they had to turn to banks for short sales and then foreclosures, and they were all competing against each other, and they had to sell. So now you had this big pressure on prices. We're not anywhere close to anything like that, and we're not going to get there. So I'm not really that worried about prices caving in these areas. They could come down slightly. All depends upon rates.
So I also wanted to ask you, are tariffs already impacting the market quicker than anticipated? I've seen some chatter on different platforms. If they haven't already, how long can we expect to wait till there's an actual impact in the market?
The only time that we're seeing some sort of a little bit of tariffs impacting the market is when it impacts investments. And that's why they announced those 10% tariffs to China, and those ridiculous 25% tariffs for Canada and Mexico. When did they make that announcement? They made it on a Saturday when the markets were closed, so that there would be a lot of posturing. And by the time we got to Monday morning, really at first everything caved, and then there was all of a sudden it was put off for 30 days. Mexico, and then later on in the day, Canada's was put off for 30 days. It was, and then you did see the impact in the markets, but that impact was quickly erased because those tariffs were punted down the road. So that's where you can't, if they're permanent, then you can start to see some sort of a real, that there could be a real effect within the rate environment and in what investors do, because they have to diversify, they have to change things around, they look at to see where these tariffs are going to go, where they're going to hit, and then it changes the whole makeup of how their investment works. There could be, you have to wait and see as to what ultimately happens, because a lot of people think that these tariffs are inflationary, which is true if they enacted them all and kept them at a high rate, but that's not what they've done. And that doesn't look like that's what they're going to do. It's been, you could tell that right now it's been used more as negotiation than anything else. So really then at the end of the day, we're not making that many prognostications of where things are going to go based upon tariffs, because the tariffs haven't really stuck. And we've looked at it to see what the impact would be, but we think that there will be some carve outs and different things, kind of like last time when Trump did some tariffs for China. But there were definitely some carve outs. But there were some industries where it did affect. So their industries. So there was a bit of a hit in certain segments of the marketplace. I'm not sure bonds are going to be that. And we're not also certain that if they just do these bit pieces, this piece here and this piece there of the segments of the economy, that it's going to have that big of an impact on inflation. But it's like one of those wait and see. There's a lot of uncertainty that's out there, and we're definitely watching on the sidelines like everybody else.
So I want to transition over to the home insurance topic, since obviously for the past what feels like a year has been just a huge like event going on. So from someone based in Texas, they said that their insurance went from $2,300 to $4,700 a year on a renewal when they never filed a claim. So how do you see home insurance rates evolving over the next year?
Yeah, so I've done some various studies, done some looking at different tables of where California lies and where Florida lies. Florida is home to the most expensive market as far as insurance is concerned. California isn't. If you look at where they rank, California is all the way at number like 33. And you can go to there are different lineups of how much it is for $300,000 dwelling, a $500,000 dwelling. And remember, these are dwellings, not land. In California, land is very expensive, but you're not replacing the land when it burns. You're replacing the dwelling. Now, with California being as low as it is, there's only one direction for this to go, and it is up. And that is exactly what we're going to be seeing. Is it's going to be going up in California. We definitely can anticipate that. Texas is another problem child, of course. Actually, I did this study because there's so many people that you have to look at population. And when you look at population and see what the true insurance cost is by the population amount and how large these states are, California is quite large, number one state in the U.S. So I look at things a little bit differently than what I kind of look at a loss per capita. And when you rank it that way, it's a totally different story. Number one becomes South Dakota. Number two becomes North Dakota. California is number 19 on that list. If you look at Florida, Florida is number 4. So Florida's probably should be more because they're a smaller state. They get hit harder than we do. So at the end of the day, these insurance companies are trying to make a profit. And the way that California has responded to insurance companies has been wrong. And the same thing bodes for Florida. And the same thing, who knows? There's not enough study yet done on the way that these different states are working with it it, but Texas could be up there as well. They're allowing their companies at least to charge a lot more. And that's what you have to do in order for them to make a profit and for insurance to be available within the state. You can limit and say, you know what, you cannot increase rates too much on our citizens. At the end of the day, what ends up happening when they do that are these insurance companies leave. And so while their insurance costs might be going up like crazy in those states, at least they'll cap out and they'll have insurance companies that will be competing against each other. When you don't have insurance companies competing against each other, it has to become the state at the last resort that has to put this together. And when you allow a public entity to put together something like this insurance, it just doesn't work very well. As a matter of fact, California has an insurance fund. They have this insurance of last resort, and a lot of people were within it, and it already went belly up and they didn't have enough money for it. So, but don't worry, they're charging all the insurance companies, everybody that was around, everybody's making up the difference of the gigantic losses that they're currently dealing with. So let this be an important lesson to these states that they need to fix the situation. Besides California doing a better job of fire management across the United States, across California, that's something they can do. You learn from these disasters. Orange County is one that definitely learned from the different disasters that they've had, and they've done a lot better job mitigating the amount of damage that's done. So we learn from these experiences and build better dwellings and have better codes and things like that. And that's what's happening across the United States. That's what will continue to happen. And will allow insurance companies to come in and insure these properties because there won't be the mass devastation down the road if they are properly built and if there's the proper fire mitigation or flood mitigation or hurricane mitigation or whatever you could do to help keep that damage to a minimum. So this is just something that everybody's going to learn from. And the number one thing we're learning is that insurance costs are going up across the United States. It's not just California that has a problem. It's a whole bunch of states where they have big, giant problems with insurance as well. It makes up a bigger chunk percentage of their overall housing costs. In California, it's not as big of a chunk because these housing payments are gigantic. So, yeah, you can imagine these having to pay a lot more. However, at the end of the day, it's compared to what you're paying on a monthly basis, it's a smaller portion of the overall monthly payment as compared to places like Texas or Florida, or I talked about North Dakota, South Dakota, that type of thing.
So, a question for you on the Department of Government Efficiency. So, Elon Musk recently said this: as it becomes clear that at DOGE is working, you will see the long-term Treasury bill yields fall, and all Americans will benefit from lower interest payments on mortgages, small business debt, credit card, and other loans. So, Stephen, is this something that you see possible, or something that we just have to wait and see how everything unfolds?
Yeah, unfortunately, although Elon Musk and the Trump administration are doing their best to kind of balance the budget, which it has not been done. It wasn't done. Barack Obama seriously took the budget and just spent like crazy. And then after Barack Obama came Trump. Trump said, "Yeah, you know what? I'll do the same thing." He also did turn that dial. Then along came Joe Biden, and he did the same exact thing. And then Trump's back, and now all of a sudden it's important to balance the budget. It wasn't last time, but it is this time. And I actually think this is actually a good thing. It's a good exercise to do. Are they going to be able to save so much that you're going to watch 10-year treasuries come down like crazy and mortgage rates come down like crazy? That's where the economics really come in. You're going to have a hard time trimming it down to the level that they want to trim it to in order to have that kind of an effect, because there's a lot of different programs that it's already dialed in through Congress that are out there, and some of them are like Social Security. There are a lot of different benefits that are out there as well that they're already in place. And you have veteran benefits and a whole bunch of things that you just can't touch. And I think it's like 7 trillion. There's 2 trillion that they're trying to play with. Other than that, there's 5 million that is locked in. That there's nothing they could do to touch it. So they could take that 2 trillion and make it a little bit less. That's why they said, "Oh well, we can't do 2 trillion. Our aim is 1 trillion." And at the end of the day, it's not going to be even near that 1 trillion mark. Not enough for it to make that big of a difference, and not enough to drive interest rates down. But we can all say it's a step in the right direction. Everybody says that there's a lot of there's too much excess in the system. So it's a step in the right direction. You can argue, is it the right way of doing it? Could there be more talk about it? You know what? I'm not a politician. I don't get into politics. I just look at the economic impact of everything.
So, according to Resi Club, the median age of first-time U.S. homebuyers hit an all-time high at 38. So 10 years ago in 2015, which is absolutely absurd, it was 31. Are rates the sole answer to fixing this affordability issue and age disparity?
So part of the issue here is twofold. Yes, rates will help big time as soon as rates come down. But we're going to have an inventory issue really quick. And you can already see where we are. If you look at inventory levels, where they were since the Great Recession, after the Great Recession from 2012 on, you watched inventory levels and the slope was down. And there was fewer and fewer homes from 2012 all the way till we got to 2020, the beginning of 2020. That slope was down and we were getting fewer and fewer homes. We weren't making enough across the United States. It didn't matter. Builders weren't going to build extra homes waiting for when more millennials and Gen Zs would come around and buy. That's not how they work. They work for a profit, so they only build to demand. So that's why you saw the numbers dwindle down more and more and more. Plus, you have baby boomers aging in place. They're not turning over properties as much. There's a whole bunch of factors that work into this where the inventory levels got down to a place where just not enough homes on the market. So it's a two-prong issue because when you compare to 2015, there were a lot more homes compared to when we got to 2020 prior to COVID. Compared to where we are right now, we're at inventory levels that we last saw towards the end of 2020, but we're still lower than where we were at the beginning of 2020. So we're still at a low amount. And even at the start of 2020, it was still too few homes. So that's part of the problem. There's just not a lot of houses out there. So who wins? It's the people with the biggest down payments, the dual incomes, the people that save a little bit more. And by the time you hit 38, you've saved a little bit more, a lot more. So at that point, and a lot of it's dual income that's out there now as well. So as a result, you're seeing that it went from 31 to 38. And know that this is the median. This doesn't mean that you have to wait and say, I can't buy anything till I'm 38 years old. It's the median. Median is the middle value for the first time home buyer. It's gotten higher because when you're 23 years old, you're not going to pull the trigger on a house for a lot of people, Mr. Brennan Thomas, and my boys. But there is a point where you're starting to get a little bit older. How old's Kyler? I think he's 27, and he's at the point where he has a good job. Maybe he can start saving for a down payment. He gets a house and then rents to two brothers. I don't know. That's a way of doing it. And then he's into purchasing. Well, all of the kids can do that. I have enough kids where we can continue to do that, and all the other kids can rent from them for a while. So that's the beauty of having so many children. But it doesn't mean that you have to wait till you're 38 to purchase something. But that does say that there's a lot more stressors into when people can actually pull the trigger and purchase their first home.
Yeah, so you pretty much did solve part of the affordability issue with having so many kids. Um, yeah, so that's a good thing. But thank you, everyone, again, for tuning in to another episode of Let's Talk Housing. Again, if you want to learn more about what's going on in the real estate industry across Southern California, Bay Area, Phoenix, Vegas, and maybe more to come down the years, who will know? But check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. We always appreciate it. We want more people seeing this information. It's good stuff. And if you have any questions at all, please feel free to reach out on our social media platforms, or you can email me personally at info@reportsonhousing.com. We will see you very soon and have a fantastic rest of your day. Thank you.
Thank you.